All right, we are live here at the Fireside Chat on a very warm day in Pasadena, California. All right, we're going to get this party started. Tony, you ready?
Sure.
Fantastic, fantastic. All right, I'm going to put my glasses on so I hopefully can read everything. Well, everybody, welcome. I am Cynthia Cohn, and thank you so much for joining us today. I'm actually live here from my living room right behind us, and I have a very special guest joining me this week for my fireside chat. And many of you know, I actually own a boutique residential real estate brokerage right here in Pasadena, California, and it's called Cynthia Cohn and Associates. And I'm very proud to lead and own one of the very few women-owned residential real estate firms in the state of California. And as my real estate career has grown over the past 20 years, so really has my passion for protecting and caring for and really creating maximum results for my clients. One of my absolute favorite parts of my job and owning this business is really bringing people together and serving as a trusted advisor to my network. I started hosting these fireside chats. Tori, how long have we been doing them? I have my assistant Tori here with me. I think we've been doing, this is like 6th or 7th one. So we've been doing them every other week or so. And really what I've been doing is inviting an expert in their field to join us and to answer some of your questions and give you the insight into the more nuances in the different industries and markets. So far this year, let's see, what have we talked about? We talked about the 2021 real estate market through the buyer's lens with Cal Anton and John Thompson. That was really terrific. We also had a special guest with KW, Karen Dillon, and Eric Ehrenstoff talking about how to purchase multi-family property. We also had Phil Barbaro here. We talked a lot about why everybody needs some type of estate planning. We invited Delinda Crampton in from broker with Berkshire Hathaway from the Las Vegas market. She really gave us an update on the state of Las Vegas and why Nevada and Las Vegas might be a really good option for some of us thinking about moving or buying a second home. We also talked about really the fundamentals of accessory dwelling units. That's a huge hot topic, how to turn your garage space into income and increase your home value. So that was awesome. We also had Yolanda Isham from Arizona talking about really the Arizona and Phoenix real estate market, because that honestly has been coming up for a lot for me and my clients. A lot of people interested about that. And most recently, we had Mary Winters join us, a geriatric care manager, really talking about an aging parent. And so I see, Alina, you're here. Let me just go ahead and pin. Tony, we're going to go ahead and pin. Let me pin you. And there you go. And I'll pin you. There we go. Okay, perfect. And then we have a couple guests that are here. So make sure they're there. So anyway, Mary Winters was here and we talked about aging parents. So as you can see, I'm just bringing in a lot of my friends in the industries, talking about what they know and inviting my friends and associates to come join and learn. We are recording this, so we do put this on YouTube afterwards. So any of you joining us today would like more information, please reach out to me and I can send you the link so that you can listen to this great information. So this week we have Tony Phillips joining us. Tony, I'm so glad that you are here because you're going to be talking to us today about how to sell your principal residence and pay zero tax, right, Tony?
That's it.
Tony is a partner in the certified public accounting firm of Phillips Company, practicing in the areas of federal and state and local tax compliance. He works with individuals and partnerships and corporations and fiduciary taxpayers. He has a plethora of experience in this industry. And he also, which makes him extremely unique, and I don't know anyone else like him, he is the president of Downstream Exchange Company, which acts as an accommodator in tens of thousands of tax-deferred exchanges. So what a great compliment. He's a certified public accountant and he has taught real estate classes in various city colleges. And really, since becoming a Department of Real Estate approved instructor and being named to the California Association of Realtors state faculty, He has given numerous seminars on tax deferred exchanges and the use of an accommodator as well as other real estate related subjects. So, as you can see, Tony has a ton of experience in his field, and he's here today to share some of his knowledge and his advice with us about how to sell your principal residence and pay no tax. We all want to know the answer, Tony. So, before we jump in, I would love for Tony to share a little bit about himself. Tony, welcome.
Well, welcome. Thank you very much. I
Please
appreciate that.
introduce yourself.
Well, as you said, a CPA. I have a practice here in Pasadena. I also have a accommodator company that acts as an accommodator in 1031 exchanges. But I graduated from Drexel University in Philadelphia, Pennsylvania, and got my BS there. Then I went and worked in New York for a while, a couple of years in New York. And then I came out here to California and I decided to get an MBA. I got an MBA in finance. And then I also went back later in life and got an MBT, a Master's of Business Tax. Both of those advanced degrees were from USC. And I have a very narrow education. You know, it's in accounting, finance, tax. I mean, I'm the most narrowly educated person in the world. I think when I come back in another life, I'm going to get a master's in what's that called? Political science or something like that, or art history, something that's different.
Yeah.
And I've been a CPA for a long time. I'm very blessed to have my son, who is also part of our firm, not our CPA firm, but our accommodator company. He's a lawyer. He's graduated from UC Santa Barbara, and then he went to McGeorge Law School. He's been practicing law as a tax lawyer for a long time. And it's kind of fun to have your son in the business because, I see him every day. And we actually work very well together. We've never had a significant argument about anything. I'm leading a good life here.
What do you like to do? And just curious, a couple questions, personal questions I just wanted to ask you. Firstly, how did you get interested in this line of work?
I'd won a academic scholarship, a City of Philadelphia scholarship. And that meant I could go to any school in the city of Philadelphia. And that was way back when you didn't have counselors and, good counseling system or, what you should do in life kind of thing. So I went back to my homeroom brother who pointed out that I had placed number one in physics. And he thought I should be a physics major. So I decided to go look at the physics department at Drexel. And I went and those people that were majoring in physics just weren't my kind of people, So I decided to go back and say thank you very much to the people I were talking to at Drexel. But then somebody says, well, why don't you go look at the accounting department? And that's like physics, and what do I know as a 17-year-old kid? I went around and I liked the accounting department, and I have never regretted that decision. I've been a CPA all my life, and this is a wonderful thing to do. So,
well, it sounds like you aligned, your strengths, beautifully when you were very young, and you were able to now, have both of these companies which complement each other so well.
Yeah.
What do you do, Tony, in your spare time, especially through the pandemic? What do you enjoy doing when you're not working?
My wife and I, let me put it differently. My wife has a very active social life, which I participate in. That's a better way of putting it.
I love it. That sounds wonderful.
And we belong to various clubs and we dance a lot. We're both very good dancers. So that's always a lot of fun.
Oh, that's great. What kind of dancing do you do?
All.
Ball dancing?
All.
Oh, all. Okay.
Dancing.
Wonderful. Oh, that's great. I didn't know that about you. See, just ask a couple questions. Well, wonderful. I'm really grateful that you're taking time to be here. I know a lot of people, this is obviously, one of the reasons why we have probably one reason why we have shortage of inventory in our state. So I really appreciate that you're coming here and talking about some unique strategies. And you're going to give us a presentation today. So usually on my fireside chats, I do have questions and then you would answer, but I know that you prepared a wonderful presentation. So why don't we go ahead and get started. I'm going to unpin myself so you can have center stage, and I'll let you go through. And then at the end, we're going to have some questions, but would you mind, Tony, if along the way, if there's any questions? I know Alina's on the call. Anybody has any questions, can we ask you?
Sure, not a problem.
Okay, wonderful. Well, would you like to go ahead and get started?
Sure.
Fantastic.
Okay. Basically, what I'm going to be talking about today is, how you can sell your home and vacation home and relatively pay no tax. So let's get started. As I gave a little bit of a idea of what my background was, and then also I gave a little bit of a background as what my son has done. So the 5 things we're going to talk about today is the sale of a principal residence, the sale of a vacation home, then the exchange of a principal residence, and then the exchange of a vacation home. And then we're going to leave time for questions and answers. So let's talk about the sale of a principal residence. One thing I wanted to make sure everybody understood that after May 7th, 1997, a taxpayer can no longer purchase a new principal residence that's equal to or greater than the net sales price of their old principal residence and roll over the gain. That's an old section of the code. That's section 1034. That section of the code has been replaced by section 121. And I don't believe how many people remember the rollover provision, and it just doesn't exist anymore. So you no longer can roll over the gain on your principal residence if you buy another principal residence. You're now really kind of stuck with section 121. Now, section 121 is a good section. I mean, it has some real big benefits. Basically, you may exclude up to $250,000 in gain on the sale of your principal residence if you've owned and lived in it for 2 years. And I want to emphasize that means 730 days. The 730 days do not have to be consecutive. They can be, 1 year here, 1 year there. It could be by month. It could be by week. Out of the last 5 years that you had a principal residence. So you have to own the principal residence 2 years out of the last 5 years. And that becomes very important when we kind of go through some of these strategies. The exclusion of the gain is also available for a condominium unit, a residential stock cooperative. So it kind of is a very broad description of what the principal residence is. And I want to stress that you do not have to be, the use does not have to be contiguous. It can be by week, by month, by year. And then the other thing is the exclusion only applies to one sale every 2 years. So let's look at it a little bit better, a little closer. You can get a $500,000 exclusion if you file a joint return and the spouses are living together and either spouse meets the ownership requirement. Both spouses have to meet the use requirement. And also neither spouse has to have a sale in the preceding 2 years. So that's a very generous, kind of view of this particular section. Also, when spouses are living apart, they're entitled to, each one is entitled to a 250 exclusion. So that's another benefit. A single taxpayer who marries another taxpayer who has used the exclusion within 2 years, that single taxpayer is allowed the 250 exclusion. The other spouse who has used the exclusion, as the code kind of intimates, are tainted spouse. spouses are tainted for lots of reasons, but in this specific situation, what it means is they've taken the exclusion within the 2 years. A surviving spouse who hasn't remarried, they can be eligible to claim the full 500,000 exclusion from the gain on the sale of a principal residence. But usually, what happens is the step up in basis usually takes care of that particular situation. And also, you're allowed a proration of the exclusion. So if you fail to meet the 2-year test, you can, or excuse me, if the taxpayer has to sell because of a job change or health or unforeseen circumstances, they also can prorate the exclusion. So when they first passed this particular section of the code, it was a tiny bit restrictive, but then they came back and did some technical corrections to it, and it made it, even very beneficial. Also, too, the taxpayer can elect not to have take a Section 121 exclusion. And I kind of thought about that for a while, and I thought, well, a situation where that may apply is that a taxpayer can have 2 residences that qualify as their principal residence. Like the rock star who lives at various places, and they can elect not to take the exclusion on the first sale if they're selling 2 of their residences. So you can only take the full exclusion once every 2 years. So it's an all or nothing. So you may have a small gain on the sale of the first, small gain on the first sale and not take the exclusion on the second sale. So it has a little bit of flexibility with that. So let's make some assumptions. Let's look at an example. Assume you and your spouse purchase 1979 a home in Pasadena for $50,000. And over the years you owned it, you put in $150,000 worth of improvements. To keep the example simple, let's assume there's no current mortgage on a home, and you and you sell it for $3 million. All right. So if you look at this, you have a $3 million sale. Your selling cost, let's assume, 6% selling cost, 180,000. Your net sales, the difference between the sale price and the selling cost, net sales is 2,800,000. As we pointed out, the example, $50,000 purchase price, $150,000 in improvements. They put in a total of $200,000. The gain on the sale of the residence, $200,000 from 2,820,000 is 2,620,000. If you meet the requirements, lived in a house 2 out of the past 5 years, you would, and you were married, you would get the 500,000 exclusion. So the taxable gain is the difference between the 2,600,000 and the 2 million and the 500,000 is 2,120,000. The tax of that's going to be roughly $758,862. So that's how for the purpose of this particular discussion, that's what we're kind of using. And if you kind of work through it, I give you a little bit of the how I calculated the various numbers. We're using, of course, since it's a large gain, and we're using a 20% capital gains tax. You have a 3.8% Medicare tax, and that bracket you'd have 11.3% California tax. So multiplying the gain of 2,160,000 by 31.1%, that's how I came up with the $758,000.
I have a quick question, Tony, on that for the capital gains tax. Is that a tax that has changed?
No.
It's always going to stay 20%?
The capital gains tax is really based on your adjusted gross income. And if your adjusted gross income exceeds your taxable income, if your taxable income exceeds $400,000, you're going to be taxed basically at the 20% rate. Okay. All right, now let's think about vacation home. Okay. Let's assume that in addition to their principal residence, they also purchased a vacation home at the beach. All right. And assume you purchased that for $50,000 back in 1979. And then over the years, you put in, another $150,000 worth of improvements. Again, we're, for the sake of the example, we're assuming no current mortgage, and assume you sell that for $3 million. And that is a big scenario here in at least Pasadena, San Marino, Arcadia. That has occurred more than once. People have purchased houses at next to nothing, and by today's standard, and also purchased a beach house, same or roughly the same time, and that has happened more than once here in Pasadena. So again, the numbers are the same. Sold it for $3 million. You have sales costs of $180,000. You have a net sales price of $2,820,000. Your basis in the house is $20,000. Your gain is $2,620,000. But it's not your principal residence. It's your second home. You don't get an exclusion for that. All right. So your taxable gain is the $2,600,000, and the estimated tax on that is like $19,260, $620. So those are significant numbers. So let's assume that you sold everything, and you sold your principal residence for a net cash of $2,160,000, and the way you get that is, of course, you have your net sales price less the amount of tax that you paid. So that's going to be a net of $2,061,000. And you sold your vacation property for a net cash of $2,061,000.
Are you on listen to?
That's made an error there. That's a mistake. But the gain is going to be, or excuse me, the cash that you're going to wind up with is the sale price less the amount of tax that you paid. So basically, you wind up with cash of $4,122,000, and you pay tax of about $1,600,000. And some people have obviously can't fit into the circumstances I'm going to describe, but some people have paid that amount, and that's a lot of money to pay.
Cool. Okay.
Tony,
I'm
hold
in
on
La
one
Piñata, as
second.
you know,
I'm
so
sorry.
I guess if I
everyone-
read now, I'll catch you.
Can you hear that? Can everybody put themselves on mute, please?
John Belcher has.
Cool. So I'll meet you. I'll give you a call on this
Okay.
number.
There we go.
There we go. Okay.
Okay.
All right. Let me just do this.
All right, go ahead.
Okay. All right. Let me just get to. Okay. Okay. Now, let's assume you exchange your principal residence. Well, how do you get yourself in a position that you can exchange your principal residence? Well, first of all, there's a section of the code, section 1031, that says no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, which is to be held either for productive use in a trade or business or for investment. Well, you want to kind of get yourself into that circumstance. Property, and there's kind of three requirements of getting yourself in that circumstance. The first one, of course, is property given up and the property received must be held for productive use in a trade or business or for investment. The second requirement is that property must be exchanged solely for property of like kind. And then the third requirement is there must be actually a reciprocal transfer of property for another property. All right, so those are the three requirements that you have to get into. Well, again, the assumptions are the same. You buy a house in Pasadena for $550,000. You put in 150,000 improvements. You assume you sell it for $3 million. You have no current mortgage. And also, I want to add the circumstance that you assume that the assessed value is $633 because of Proposition 13 and the 2% increase in the valuation of the property would give you roughly an evaluation of or assessed valuation of $633. Sorry, $633,000. Again, the numbers are the same. You're selling a principal residence, or not, excuse me, you're exchanging a principal residence, and if you can kind of work out the details, you can actually get the 500,000 exclusion and do an exchange. And here are kind of the details. Let's assume you refinance your home for $1 million. There's no tax on refinancing a home. All right. You borrow $1 million on a $3 million home. Bank is likely to do that. Okay. And you take the $1 million and you go buy a condo in South Orange Grove for $1 million. Plenty of condos in South Orange Grove for, in the price range of $1 million. You move into the condo on South Orange Grove and transfer your assessed valuation, because you use Proposition 60, to $632,000 from your home to the condo. That works. And then you rent your home out for 2 years. Well, you think about that and you say, well, I now have established that property as a rental property for 2 years. You exchange your home in the third year. Now, if you kind of think about that, if you look back over a 5-year period of time, you're going to have, you lived in a home for 2 of the years, and you rented it out for 2 of the years, and you exchanged it in the third year. So you've met the requirement of establishing your home as a rental property, but you've also had the requirements, you met the requirements of living in a home for 2 out of the past 5 years. So not only do you get not only do you now have the ability to exchange your home because you rented it out for 2 years, you can also take the 500,000 exclusion because you lived in a home 2 out of the past 5 years. So you get both. So at the end of this kind of daisy chain of events, you use the $500,000 exclusion. Oh, excuse me. And then you use the 500,000 exclusion. You take that in cash as part of the exchange, and you pay down your mortgage. Remember, you borrowed $1 million. You pay down your mortgage of $1 million by 500,000. So now you have a mortgage of 500,000. You then exchange your home for a piece of property, have an evaluation of $2,500,000, and you have to have still have to have that mortgage of $1 million. But at the end of this, okay, and then you have a $1 million condo with a mortgage of $500,000. That's what happens. You basically wind up with rental property of $2,500,000 with a $1 million mortgage, and you have a $1 million condo with a mortgage of $500,000, and you paid no tax because you've done exchanges. You see.
And
so
that rental property could be also land. Is that correct?
Yes, it could be any kind of piece of real estate. Land, like raw land would be considered real estate.
Mhm.
Of course, that rental property could be a duplex, triplex, fourplex, 6-unit apartment house. It could be anything. Okay, anything considered real estate. So you wind up with, by doing this exchange with several pieces of property, not several, couple pieces of property, and eventually paid no tax. But now let's look at the vacation home. Let's assume that instead of purchasing your beach house and owning it personally, you purchase it in an LLC. And even if you currently own your beach house personally, you can always transfer it to an LLC. The reason I like putting things in LLCs is the stated purpose of the LLC is to rent out the property. When you or your family use the beach home, you pay rent because you got to carry the property anyhow. You got to pay the property taxes. You got to pay the maintenance, things like insurance, things like that. So you might as well rent it. And also too, I find that when there's multiple family members, multiple siblings, there's always this slight tension as to, Joey's using it more than Mary, and why is Joey using it more? But if Joey pays fair market value rent and Mary pays fair market value rent, then it kind of evens out a little bit. And especially when it gets down to multiple grandchildren, it kind of really makes sense. And it also helps to rent out this vacation home, beach home. Also helps to rent it to other third parties. What you do is you basically now take it off of Schedule A and put it on Schedule E, which you now have avoided the limitation on interest. Remember, you have limitation on interest. You can only deduct interest on $750,000 worth of property. But if you get it off of that and get it onto a different schedule, you now have unlimited deductibility of your interest. And also you avoid limitation on property taxes because again, it comes off of Schedule A and goes over to Schedule E. And you now have the unlimited ability to deduct property taxes. So you, in effect, make it become an investment property and hold it out for rental. One other benefit is you get to depreciate it because it's a rental property. Right? So the big thing is it becomes eligible for an exchange because it's if you remember the criteria, that it has to be used in a trade or a business or held out for rental. All right, so you've kind of maneuvered yourself into a very favorable position and allowed yourself to be able to take your vacation home and convert it into a investment property. And then if you exchange it, you have sold your principal residence and you've sold your vacation property. You basically have you basically have $4 million worth of property. I messed around with this too much here and paid no tax. That's the slide I wanted. Okay. You purchase and then what you've done is you purchase $1 million condo with the mortgage of $500,000. You exchange a piece of property, you have an evaluation of $2,500,000 with a mortgage of $500,000, and then you exchange your beach house, $3 million with no mortgage, you basically wind up with $6 million worth of property, a mortgage of $1 million, and paid no tax. I mean, isn't that what you kind of want to do?
Yeah, absolutely. Tony, what like price point? I know we're talking about a $3 million house, let's say primary residence that's paid off. What about someone that owns a house that's $1.5 million and it's paid off? They could,
You
yeah.
you basically, well, there's a kind of a threshold.
Mhm.
You basically have to worry about having a enough asset to buy another asset. You see,
Yeah.
uh,
Yeah.
if you don't have that threshold amount, then you can move out of your $1.5 million house, rent it out for 2 years, then exchange it for another property.
Mhm.
But you kind of have the situation where you can't buy that place to live.
Mhm.
All right. Now, if they have other sources of capital, like other assets, like say they have $1 million lying around, then they can go out and buy their new principal residence and exchange the old. No, then they exchange the old principal residence and have a circumstance where they can exchange into a property. Yeah, they can exchange their property and exchange into another asset.
Mhm. Yeah, I can see. I have had many clients that probably could do that. They could even take maybe a line of equity on their principal residence, move out, rent it out, use some of that plus some other assets that they have, and buy a house, let's say in Texas for $500,000.
Exactly. You have to kind of look at the circumstances. And I made it very easy because I wanted to kind of make it a very sweet spot. But then, depending on the facts and circumstances, uh, sometimes they're selling a $5 million house. Well, it's pretty easy if there's no mortgage on it.
Mhm.
But when you get down to the lower values, you kind of think about it a little bit.
Mhm. Mhm. Well, I know that comes up for a lot of clients in our area as well, who, they're very concerned about the tax implications. Can you talk to us? I do want to take questions from the group. Let's do that first. John or Alina, did you have any questions for Tony? And I'll see if we have anything on Facebook. We do. What questions do we have?
So Corey Harper asks, what about cost recovery recapture at 25%, then 20% on the capital gain?
Could you hear her?
No.
Okay, let me take a look. Corey Harper is on Facebook. Hi, Corey. Thank you so much for joining us. He says, what about the cost recovery recapture at 25%, then 20% on the capital gain?
Well, you kind of think about it. You only recover if you have, now what she's talking about is there's a 25% capital, excuse me, there's a 25% tax on the recapture of depreciation. All right. So if you think about it, you only recapture depreciation if you have a taxable gain. But if you do a good exchange, you don't have a taxable gain, so therefore there's no recapture.
I see. Okay, Corey, I hope that answers your question. Can you talk a little bit, Tony, about step up in basis? And for anyone listening today might not understand what that is.
Sure. Basically, what happens is you, when you pass away, the decedent spouse gets a step up in basis in their assets. Okay. If you own the property or own the assets as community property, not only does the decedent spouse get a step up in basis, but also the surviving spouse gets a step up in basis. All right. Now, of course, this is all in the current law. So it's very advantageous in most circumstances to hold your assets in joint, as community property, as opposed to joint tenants, because you get a step-up in bases in both assets. So that's just part of the law, that your assets get redefined or reevaluated at the date of death to the fair market value. But that's under current law. Current administration is kind of thinking about changing that.
Can you tell us a little bit about that? Because that was my question. Is it true the current administration is trying to get rid of the 1031 exchange as well? So tell us about that.
Yes. Well, they're not, at least the current discussion is they may not get rid of it, but if you are a single person, you can get a 500,000 exclusion from the capital gains tax if you do a 1031 exchange. And if you're married, you get $1 million exclusion. So, but they're kind of they're trying to, narrow down the benefit of 1031 exchanges. It will definitely freeze up the market. They will not. People won't exchange. They won't do it, and that's the problem. They think they may get $40 billion for additional tax, but that's not going to happen. People are just not going to do exchanges. Why do it?
All right. Any other questions? Any other questions at all? Wanted to see if I have anything else.
Yeah, hey, I have a question. It's John
Oh,
Bunker.
awesome. Hi, John.
Hi. Great presentation, by the way. What happens in your scenario if instead of buying a condo on South Orange Grove, you rent? You move out and you rent your house for 2 years, and you've decided that you don't want to have a mortgage. Does it work the same way if you just rent the condo, that you get the same ability to exchange it into an income producing asset?
Yes. You have your house that you eventually sell for $3 million. You've lived in it 2 out of the past 5 years. You rented it out for 2 years. You just exchange for whatever property you want to exchange for. And I'm just trying to, the reason I have you living in a $1 million condo is that's what kind of a maybe 75% of the people do that. Some go to the old age home and don't make the intermediary trip to the condo.
Not me.
But
Me, Tony.
All I'm doing is just trying to provide for some place where people can live. But you can rent.
What if instead of renting your property, what if you turn it into a deal where it's actually a business and you have, for example, a hospice care, or you have multiple people that are renting? Is it the same deal?
Yes, it has to be a rental property or a property held out for trade or business.
Have you seen people pull that one where they have a really nice house in San Marino, Altadena, La Cañada, and then they find a medical doctor or whatnot and turn it into one of these hospice care deals?
Yes, there's been 2 of those that happened.
Did it work out well?
I've not followed up on that just yet because they're still in both of them are still within the 2-year period. But after the 2-year period, certainly going to find out what happened.
Hey, thank you so much. I really appreciate you answering my questions. That was very insightful. Thank you.
Okay.
I'm just glad you joined us today. Well, I think that concludes our meeting. Tony, may I ask you to stop sharing, or is it okay if I stop sharing that? think I can do it.
There you go.
Here we go. Wonderful. And let me go pin here and add the pin. There you are. Wonderful. Well, I am so appreciative of you, Tony, for coming today and sharing your hour with us, talking about your expertise. You are amazing and a plethora of information. And it's always such a pleasure to see you. To everybody on this wonderful fireside chat today, if this interests you at all, this conversation interests you in any way, please don't hesitate to reach out to me. And you can do that by email or phone. You can reach me at 626-714-6808 and at cynthiacohn.com. And again, I am the owner of Cynthia Cohn and Associates, one of LA's few woman-owned real estate brokerages. And to us, there is nothing more important than you and your dreams and your goals. Our mission is simple: to provide you and your family unmatched value by delivering world-class protection, heartfelt care, and guaranteed results. That's what you deserve, guaranteed results when you need and deserve it most. And if you're interested in selling or buying a home, please don't hesitate to reach out to me. I'm really here as a resource to you. I'll be sending out a follow-up email with more information, including Tony's contact information. And I know Tony is more than happy to answer any questions you have. Tony, for them to get a hold of you, what's the best way they could reach you?
Our number is 626-796, now don't laugh, 1031. So you laughed.
I love it. That's really great. I love that. How did you make that work?
Believe it or not, one of my CPA clients was moving, and I didn't notice her number at first, but then one of my associates says, well, look at her number. And it was 1031.
Oh my God, that's brilliant.
A fabulous number. Now, of course, we have other numbers that still are end in 1031. We've acquired a number of practices and we've taken their numbers. So.
Mm-hmm. Well, Tony, thank you again. And thank you to all of you for listening. And I wish you all a wonderful evening. Enjoy it. And we'll be back here in a couple weeks again. So Tony, thank you so much.
You're welcome.
All right. Talk to you soon. Bye-bye, everyone.